All right, tariffs hitting hard, but stocks not really reacting. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, Beijing's warning. China vows to hit back with all necessary measures as President Trump fires new tariff threats. And all that tariff talk is rippling through the markets with CEOs from Amazon to Hewlett-Packard sounding the alarm. Plus, a multi-trillion-dollar mistake. Citi reportedly credited $81 trillion to a customer account instead of $280. Details ahead on that blunder at a bank that has a history in that sense. First off, though, let's take a look at where the markets are trading. In terms of stocks, you actually see gains on futures this morning. S&P futures up 0.2%. Of course, we had a big 1.5% drop yesterday. And you do see really an elevated VIX, but the 10-year yield continues to move lower. Right now, 423.68, and we kicked off this administration around 475. So they really have moved down that yield. The question is, for what reason? Is it a growth scare, or are we confident that inflation is under control?
Stunning. 423. We are more than half a percentage point lower than we were just in January. Let's see how low we can go. Some things moving lower as well. Those big tech stocks, particularly HP here. Of course, we're looking at the numbers down more than 4% pre-market. Profit outlook fell short of expectations. They cited tariffs and rising costs of components for its products. So even a lot of the macro threat really hitting into the big tech names. Dell Technologies down 6.9%, almost 7% pre-market. They plan to ship $15 billion worth of AI servers this year, a 50% jump from last year, but it's not enough to impress Wall Street. And Nvidia's ending the week where it began, which is lower, 1.8% lower today, and it's flagging as subdued growth in the last quarter, and mixed guidance for the year weighs in on sentiment, which has also been pretty muted here, Matt.
Yeah, you know what's interesting, Sonali, if you take a look at how poorly U.S. stocks have performed, it brings into question the idea of U.S. exceptionalism. Year to date, if you look at U.S. stocks versus the rest of the world, it's the worst start to a year since 1994. Some of us were barely even born at that point. And then I have here the yellow line. It's an inverted 10-year, just to show you the rate of change that we've seen in terms of Treasury yields since the start of the year. So if you bet on Treasuries, you've done well. If you bet on stocks, at least versus the rest of the world, you've done very poorly.
Yeah, this has certainly been a week, maybe a month of hiding. You have people getting into the bond market, partially because of the data, but also where else are you going to go? The Mag 7 has been a total drag. It hit correction territory this week. You have now consumer discretionary failing as well on investors. They were getting into the consumer trade at the end of last year. It's deeply negative now, Matt, because of all that weak consumer data we've been seeing.
I was 20 in 1994.
I was 4.
I was working at Generation Records downtown, just living a life of debauchery.
I was probably deeply trying to learn multiplication before school started.
All right, let's talk about the multiplication at 4. Let's talk about the Fed data that we got this morning. Some of it expected, some of it surprising, right?
Yeah, absolutely. We're going to bring in our Michael McKee for that because the PCE data was interesting. While the headline numbers hit expectations, Matt and I were looking at spending in particular. You don't see negative reads that often.
You let us down during the month. You weren't out there spending enough.
I didn't actually.
You were spending all your time with the mathematics instead of spending. But you're right. Spending was down negative 0.2 during the month after a revised 0.8 the month before. It takes off a little bit of the pain, but it does show consumers pulling back. And this follows what we've seen in the consumer sentiment numbers. And it is going to create a bit of a worry on Wall Street, probably for those consumer discretionary stocks, as you mentioned, and for the Fed. although it is, as they like to say, just 1 month's data. And personal income came in very strong. Wages and salaries were up 0.4. That's what they've been for the last couple of months. So it's not like we're losing any money here. Most of the big gain in personal income came in farm support payments, up 32%. Last year in January, they were up only 10%. 1.7%, though, increase in dividend payments. So if you're on Wall Street or on the farm, you were doing okay. You mentioned the price indexes. They came in line. Fed will look through that. Little progress being made. I want to move on to the trade balance, though. The trade balance that you mentioned, Matt. In 1994, I don't want to even say what age I was, but let's put it this way. Even at my age, I've never seen this, because this is the worst goods trade balance ever. You can see above that is the total trade balance. We get the services surplus next month. Next week takes off a little bit of that edge. But what this appears to be is companies buying stuff ahead of tariffs. Industrial goods supplies up 33% in the month. Consumer goods up 8.3%. People afraid of tariffs, they went out and bought while they could, which implies that the February trade data will go the other way. We'll get a rebound and it'll sort of balance out.
We ordered a case of maple syrup at my house.
That's probably, if you eat a lot of pancakes, waffles for the kids, yeah.
Mike, I want to get your take on the 10-year. I was out in Austin the last couple days riding motorcycles and just watching this yield drop. Why are we seeing the 10-year yield fall the way we are?
I can't give you an exact answer, because there's two stories. One is that the economy is slowing and markets are preparing for what would be disinflation if we get a recession, or markets think that inflation is coming down, but the economy's okay, and you don't need to price for you don't need to raise the term premium to get your money back. And nobody really knows at this point. That's the hard part about all this. As an economist and a Fed watcher, people who have to figure out what's going on, we welcome the asset world to our our world these days of not knowing what's going on.
A little pricing action there. Mike McKee, thanks very much for that international policy and economics correspondent. Let's bring in Cantor Fitzgerald, Chief Equity and Macro Strategist Eric Johnston. He's here at the desk at 731 Lex with us. His 2025 price target for the S&P 500 is 6,000, which, Eric, looks pretty good today at 58.61, right? But it's not a whole lot of gain year to date. Why do you think stocks are essentially going nowhere this year?
Sure, and we think it's going to be extremely volatile throughout the year. I think ultimately go nowhere. One point is valuation. So valuations are at historic highs. The allocation to equities by individual investors also historic highs, and they've poured money. They've added on to that so far this year. And I think we're late cycle. So as we think about where we are in the cycle, we've got unemployment rate is currently we're at full employment. We've had a multi-year expansion, and if you look at the stock market relative to GDP, we are at historic highs. We're actually higher than where we were in the internet bubble. So I think that makes for challenging returns going forward. And then, of course, in the short term, we do have some significant growth concerns.
That's fascinating. We talk about, which valuations to look at. I'm always looking at the CAPE ratio, but stock market levels versus GDP higher than we were in 2000.
Right. It's a nice reminder here that valuation can be calculated in a lot of ways.
Yes.
I want to go into some of the higher flyers where valuation stopped making sense for a long time, and that's the Magnificent Seven, where you've seen on valuation it correct now, just on price levels as well. I mean, 10% lower for the month. When you're talking about a market that is essentially going nowhere this year, how do you play this set of stocks that have been not only the market darlings, but also so much of the contributors to the market gains?
Absolutely. And really, it's been when you think about where individual investors have put their money over the last 4 years, a lot of it has gone into the Mag 7. There's a lot of embedded long exposure there. And if you look at some of the trends within the Mag 7, you have revenue growth that is starting to subside, revenue estimates that are going down. At the same time, cap spending is going up. And so that combination, I think investors are looking at, and for a group that is seen as capital light, that is a little bit concerning. I would also say the rate move. So these companies mostly have net cash. So they were benefiting right, from yields going higher. As yields start to come in and the market starts to price in maybe more Fed cuts down the road, they get less of that benefit. And they're becoming a source of funds for investors to buy other securities, including more defensive equities.
Is there a rotation, though, really going on? I mean, the Mag 7 stock's not doing well, but 6,000 is still higher than we are today, right? So does that mean the S&P 493 does a little bit better? Do you like mid caps, small caps?
So I like the more defensive sectors and also healthcare, which you can sort of call defensive.
Which is defensive. So you like healthcare, utilities, telecoms?
Exactly. And I think, and that's for the next, sort of few months where, although our price target is 6,000, we think we're going down first. So to be clear, we think the next 2 to 3 months are going to be tricky time. We think we're going to get some sort of a washout within equities, and then of course we can bounce from there as the different puts that are out there, whether it's the Fed put or the Trump put, will kick in, and I think that can make for a much better second half of the year. Once the tax bill is passed and a lot of that uncertainty that we currently have goes down a significant amount.
I was looking at a lot of the indexes. If you're looking at the NASDAQ, you're down, for the 100, you're down more than 4% for the month already. For the SOX, the Philadelphia Semiconductor Index, you're down almost 7% for the month. Mm-hmm. The S&P 500 has been weak. The Magnificent Seven has been down more than 10%. How much do you look at flows here? Because if you're a hedge fund playing this market, I reckon you don't have a whole lot of dry powder to get into March with a lot of conviction. If you're a retail trader, you might have been burned by all of these levered ETFs this month.
That's right.
So what are you playing with heading into March?
If you're a retail trader, please don't buy levered ETFs.
That's what's been happening.
Correct.
That's what's been happening.
That's right. I mean, and momentum factor has gotten hit very hard. And a lot of these names are the high-flying, retail-owned names. And I think, hedge funds, their gross exposure coming in, as of a few weeks ago was towards the high. And so part of what you've seen is some degrossing as, volatility has gone up. If you have the same portfolio, but risk has just shot up, your overall risk without doing anything has gone up. So in order to mitigate that, you have to bring that down. And that's part of sort of the unwind that we've seen because momentum is a very crowded factor, right? People want to buy stocks, whether it's institutions or retail, stocks that are going higher. And so that has been, and that's really been a global phenomenon, right? You talk about, U.S. versus Europe and versus other parts of the world. I mean, this has been global dollars, right, have gone into the U.S. because our economy has been a major outperformer and because of the Mag 7. And so the process of unwinding that, it takes time, right? Because it was a lot of years to get into it, and it doesn't just get clean within a week, 2 weeks, or 3 weeks.
Well, you're not going to lose your job still for holding NVIDIA. Eric, you think at least short term the economy, the outlook has turned negative for the economy, and you like bonds, which has been a very good trade as we've been showing, right? Does that continue and flesh that out? Why is that? Because of spending cuts? Because the administration wants to get yields down?
So, a couple of reasons. So I think in terms of bond yields, around why I think they continue to move lower is, yes, you have the administration that wants a lower 10-year yield. And there are things that they can do from the Treasury, right, to move where they're issuing and do different creative things to get the 10-year yield down. So having them sort of on your side is one point. They're going after the deficit. So if you think about why bond yields were going to 480, 490, part of the concern was the expanding deficit, and is it just going to continue to expand? And then the third point is the growth slowdown. And so I think most of it right now is the growth slowdown, where bond yields are sort of going down for the wrong reason. And that's why you're seeing equity prices and bond yields be correlated and have a positive correlation where they're both moving lower. And, the growth outlook, you have companies where it's extremely uncertain what the environment is going to be. And so the economy is sort of going on pause a little bit with all these uncertainties around government spending, around tariffs, around the reconciliation bill, around the debt ceiling. And so this sort of pause in activity, I think is going to filter ultimately down to earnings.
Eric, we thank you for joining us today. Of course, that is Eric Johnston of Cantor Fitzgerald. We should have on our desk little shots of coffee for every time someone says tariff. What do you think?
I don't drink coffee, so I would be in major trouble if I, took like 14 shots. Yeah.
But also, I think we need to pull out the dictionary once more. We're going to be talking about recession fears a little more. You saw that in Apollo's Torsten Slott's note. The odds rising a little bit, Matt. Not that much, but they are rising. And stagflation, if you're worried about growth and you're worried about inflation, stagflation is a bit of a market killer. It's certainly a bond market killer as well.
Yeah, I mean, inflation doesn't seem like too much of a concern today because we see the PCE number coming down so low, 2.6% at the core year over year is pretty close to the Fed's target. But definitely growth concerns. And, Eric pointed out, if you take $2 trillion out of federal spending, that does a number on growth for sure. If you see futures today, though, we're still looking at gains, right? Okay, we had a big drop yesterday, and the Russell futures are down, but S&P futures up 0.2%. 15 minutes to the open. This is Bloomberg. All right, let's get to high interest. Look at what's making headlines around the world. BlackRock is joining the latest Wall Street trend, scrapping DEI goals. The world's largest asset manager will abandon specific targets to increase the employee representation in its workforce. Representation of underrepresented groups, and will no longer require hiring managers to interview a diverse slate of job candidates. BlackRock's move follows diversity U-turns by the biggest banks, pretty much all of them, including Goldman Sachs and Citi. By the way, Lauren Sanchez, the fiance of Jeff Bezos, whom you probably noticed at the inauguration, will fly to space on an upcoming all-women flight of Blue Origin's tourist rocket, which is owned, of course, by Bezos. Joining her will be pop star Katy Perry and TV personality Gayle King. The flight will mark the first all-female flight crew since a Soviet cosmonaut had a solo space flight in 1963. And our top trade story, Beijing is threatening to hit back at President Trump after he unveiled additional 10% tariffs on Chinese imports after doing 10% already in February. The additional levy will take effect on March 4th. Trump's new measures came without forewarning and took officials in both countries by surprise. A spokesperson for the Chinese Commerce Ministry said, if the U.S. insists on having its own way, China will counter with all necessary measures to defend its legitimate rights and interests. That's a direct quote, Sonali.
And certainly from the market's perspective, that March 4th date causing a bit of anxiety. So we're going to stay in Washington. Joining us now from the White House, Bloomberg's Tyler Kendall. Tyler, you think about the tit for tat that we're seeing up to that March 4th date. How is the White House considering what could become reciprocal?
Right. Hey, Sonali. Well, importantly, President Trump made this announcement about Chinese tariffs alongside his announcement confirming that he plans to implement 25% tariffs against Canada and Mexico on the same day. And we have to keep in mind when it comes to this exact batch of tariff threats, they're really tied to some tangible policy priorities for this White House when it comes to immigration as well as fentanyl. We heard President Trump yesterday renew his accusations against Beijing for their role when it comes to drugs coming over the U.S. border illegally. And now Matt mentioned it there, Bloomberg News reporting that officials in both countries were really caught by surprise when it came to this. But it does continue what has been a recent trend from this administration to ramp up pressure on Beijing. Just in recent weeks, for example, we've seen the U.S. impose new investment curbs on Chinese investment, also proposed heightened fees when it comes to Chinese vessels that are transporting U.S. goods. And then importantly, Sonali, just last week, Bloomberg reporting that U.S. officials asked Mexican officials to hike their own tariffs when it comes to Chinese goods.
Hey, in terms of the Ukraine war, Zelenskiy is in town. He's going to try and gain a little favor with Trump. Obviously, there's this mineral rights agreement that needs to be signed. What do we know?
Right. Well, the biggest question on the table right now, Matt, is security guarantees from the U.S., something Zelenskiy, as well as our European allies who were here at the White House this week, would like to see. But President Trump has said that he's really focused on this critical minerals deal. And we've heard the White House repeatedly say that those guarantees would really be implied because the U.S. would have a vested economic interest in the future of the country. So still those deals being worked out. President Trump has mostly sidestepped questions when it comes to security guarantees. So when Zelenskiy arrives here at 11 a.m. Eastern, followed by a 1 p.m. Eastern press conference, we'll see if some of those questions get answered.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there in Washington. Going to be a busy day for her, as has been every day, I guess, since the president took office. Let's get a quick check on what's going on in futures. S&P futures continue to remain stronger. Just about 8 minutes to go until the start of the cash trade. I believe that's NASDAQ. Futures there that are down, but really unchanged. And then the Russell, the small caps are falling.
It's hard to get excited about what you're seeing up there because you do have an S&P 500 that for the week is down 2.5% already. We're not going to erase that based on what futures are doing. And honestly, below 6,000 still. I think we missed you earlier this week when we fell below that level.
No. I was here. Remember, we talked about that. I think it was on Monday.
What week is it?
Exactly. Yeah, it's been pretty fascinating, the moves in stocks, but really bonds, and you can see at the bottom of the screen there, 424 right now, the 10-year yield. We'll continue to follow this for you as we bring you the market open. This is Bloomberg. Welcome back to Bloomberg Open Interest. Looking at S&P futures that are still positive, as Sonali mentioned, you know, they've come down pretty substantially. If I look at you like this, it looks like I'm looking off screen, but I'm not because you're in a
It looks
different
cool,
position.
I think, Matt. You know, one thing that's been dragging down tech stocks is Tesla. It's lost almost all of its gains since the election in November. It's down more than 40% and on track from its highs and on track for its 7th day of losses. So if you count out Tesla, you're not doing as bad, actually. Well, coming up, stick with us less than 4 minutes to the opening bell. We're going to discuss the moves with Nadia Lovell. This is Bloomberg.
We are moments away from the start of trading on the last day of the week. Thank God it's finally here. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at futures. We're losing the gains that we had. Still a green arrow on S&P futures, but as Sonali pointed, we've seen a pretty serious drop already this week. We fell down through 6,000 on Monday, and we were off 1.5% yesterday. Red arrows on NASDAQ and Russell 2000 futures. You hear the bell ringing at the New York Stock Exchange. The U.S. Customs and Border Protection ringing the bell. There's a kid there having the time of his life. When they're not deporting people, they're opening the New York Stock Exchange for trade. And then at the NASDAQ market site, Rocket Pharma ringing the bell. To alleviate some of the stress, they've been down 25% this year. They were down 60% last year. They sold new shares in 2020 for $56, and they're trading for under 10. So it's been a rough ride, but that's life, I guess, in the pharma business. In terms of the major averages, we're looking at the live cash trade as the traders there in the NYSE open the market. We're looking at a flat trade on the S&P 500. NASDAQ down about 0.2%. Tech stocks really haven't been doing so great. We're going to talk to Caroline Hyde in just a moment. She sat down with Andy Jassy yesterday, so I'm excited to hear what she got from them. And then the small caps are down even worse, 0.4% on the Russell 2000. One stock to watch is Hewlett Packard. It's actually just called HP now, but I feel like if I said that, no one would know what I'm talking about. HP's profit outlook fell short of expectations. Tariffs they cite as a problem, rising costs of components for the products that they make. They make, you know, printers and then other stuff. The company will cut up to 2,000 employees this year in an effort to save $300 million, and the shares are down almost 8% on the day. Sonali?
It's a sour way to end a sour week. It is kind of a bummer, isn't it? This is also kind of a bummer. Dell Technologies down 7% as the market opens. Now, they plan to ship $15 billion worth of AI servers this year, and that's a 50% jump from last year. And normally that would be very exciting, but investors are still concerned about the profitability of these products, and that's, of course, reflected in the move. We're going to look back at the week that was in the Magnificent Seven because it's been pretty brutal. Over a 5-day period, you're seeing it down more than 7%, barreling towards 8%. Tariffs, inflation, a potential economic slowdown is all hitting sentiment. Tesla, we have been talking about it all week, is hurting the most, down 30% this year. But if you look at this week, it's actually Nvidia that's the worst performer, just above Tesla, if you can call it above. We're going to discuss the week in tech that was, bringing in Bloomberg Technology co-host Caroline Hyde, who has talked to so much of the C-suite and even more coming. What is going on?
We're all questioning the longevity of the AI hype cycle. And ultimately, when you get the return on AI investment, how much capacity is needed in the long term. And as you speak, really, Jensen Huang was trying to vindicate the fact that this new scaling law has arisen. The fact that we now have these reasoning models is still going to need a significant amount of compute power. But amid this context, the reason the whole market is under pressure at the moment, Sonali, is because of what's happening with the administration. What's happening in terms of the Chinese tariffs that are going to affect HP and certainly hitting some of their cost basis and why they're having to reduce people. We're seeing, of course, Dell speaking to some of the issues when it comes to the cost of goods that they're importing as well, and indeed the tariff implications. And what's interesting is it affects these chip makers. Now, just think about this AI diffusion rule. This is what was coming out yesterday. Microsoft trying to push back against what Biden put in place at the very end of his term, the idea that you can't sell very sophisticated chips, not only into China, but into allies, because it might end up in China. Now, I spoke with Andy Jassy just yesterday, asking him, look, is this an issue for you about the restrictions on selling on chips? Does it affect AWS? But he spoke more to the market. Just take a listen.
I don't know how this administration feels about it, but I would say that we share the concern that it has limitations on certain countries who are natural allies of the U.S., who just to be able to do their business and those companies to be able to get done what they want to get done on top of these technology infrastructure platforms like AWS, they're going to need more chips. And so I think if we don't do it, we're going to basically give up that business.
And what's interesting is that he's really optimistic about this administration, thinks it's one of the most business-friendly ones yet. He's spoken to President Trump, but ultimately they need some changes to be made here, Matt.
One problem, Caroline, I'm going to pick up here because in addition to Amazon, you're also speaking to the CEO of HP, and they are looking to cut up to 2,000 workers through October. All those American jobs that were supposed to be created on the heels of American productivity, where are they? Well,
it could be global in nature, and we don't know exactly where these cuts are coming. This is a company that makes a lot of products around the world. But you are right in terms of this is the efficiency. Look, I spoke to Andy Jassy about the delayering he's making of his own workforce. They've got to do more with less. And AI helps you with that as well, guys. But HP, as we're seeing them shift towards an AI PC mode, we are seeing people having to go. They're trying to think about protecting their margins. Margins under pressure because they're having higher cost of goods that they're importing, potential China tariffs on some of those, even though they've been changing their supply chains, and they have to get costs out from somewhere. And it comes to people. They've already stripped out so many jobs. They're just adding to that.
All right, Caroline, I'm looking forward to your show. I know you got a lot coming. There's a Meta deal to get financing for massive investments in AI. So Caroline Hyde anchors Bloomberg Tech. That starts in just an hour and a half. And she will have the CEO of Hewlett-Packard on her program as well, Enrique Lores. Well, actually on our program. With you guys. But she'll be joining us. So she's brought us the CEO.
For having me.
Thank you so much.
Thank you for being here.
Keep bringing us big CEOs. All right, joining us here at the desk at our headquarters is UBS Wealth Senior U.S. Equity Strategist Nadia Lovell. Nadia, great to have you here on the program. I feel like we're already so freaked out about tariffs that we're getting job cuts and market drops, especially when you look at compared to the rest of the world. U.S. stocks have had their worst start to a year since 1994, but it's only been like 5 weeks since Trump took office. So do we need to give him a little more time?
I think so. I think what's causing, obviously, the range of outcome for tariffs is quite broad, right? We'll learn more in coming weeks, but our core view is that we do expect tariffs to go up. I think what's happening also is that tariffs is being used for non-trade related issues as well. So far only the 10% is in place on China, but that's related to drug enforcement on fentanyls. We'll see what happens on Tuesday, in terms of whether you get that 25% on Canada and Mexico.
Doesn't he have to do it, Nadia? I mean, he said he was
might
going to do
have
it
to flex
last
his
month.
muscle.
He gave them another month. If he keeps saying, I'm going to give you 25% tariffs and not doing it, isn't he then the boy who cried wolf?
Potentially, but even if you do get them, we don't think that they'll last. They'll probably be temporary because these tariffs, again, are related to non-trade issues. And the fact is that the supply chain is quite integrated within North America, particularly for industries like auto. And so we don't think that that would stick. But what we do expect to see an increase in terms of rhetoric and threats. You think the threats are happening now, but we think that they're going to increase after April 1st when those reports are due from the various federal agencies to address actual trade imbalances. So ultimately, we do think that you get higher tariffs, particularly around China. We think that you get an average of 30% after the second half of this year, and probably some selective tariffs on Europe as well.
On the heels of tariffs, a lot of people are still worried about potential inflationary impacts of that. But even of what we've been seeing so far, we love to talk about what happened in tech this week, but what happened in consumer discretionary is equally alarming. The index itself is down 10% just this week. It's the worst performer in the S&P 500. Do you worry about the state of the consumer right now and whether it's screaming recession underneath the surface just a little bit? Do you start to worry?
We're not there yet, and we don't think that there's a recession. Of course, we continue to know that the lower-end consumer continues to struggle, and if we see increased tariffs, that could have a further impact on consumer spending, particularly on the lower end. But the higher-end consumer is still hanging in there. The fact that you have a stock market that's still, yes, down 5% from its all-time high, but still doing well, particularly when you look at the sector level. And so we do think that consumer spending will rebound. Of course, we know that January is always a mix, the payback after December. I think also when you look at the consumer discretionary area, it's quite, it's dispersion under the hood. When you think about it, the fact is that you have a Tesla, as you mentioned, that's down quite a bit. Some of the cruise lines have been getting hit on threat of taxes on cruises. And so you will likely continue to see that dispersion within consumer discretionary. But ultimately, we think that the consumer as a whole is still in pretty good shape.
You are the equity strategist. But I think it's really important to watch these bond moves. I sit next to Sonali, so I hear about them constantly.
That's the first thing I say to him every morning.
Every morning. And look, we're down on the 2-year yield, almost 4 even. The 10 years at, I think, 4.24 right now. There you go, 4.24, 25. Is this good for stocks? I mean, certainly, if I think about buying a car or if I think about buying a house, I'm happy to see those yields come down.
It depends on why those yields are falling. I think that the bond market is probably signaling some growth concerns. And if it ultimately becomes that, then that's not great for stocks. We do ultimately think that the Fed will decrease interest rates this year 2%, but that's going to be more driven by inflation coming down and less so by, growth meaningfully slow. We still expect growth to come in about 2%, so still pretty healthy economic growth. But the bond market has given false signals in the past, and we think right now what's pricing in is the uncertainty around tariffs and what that could do to growth.
Something that Eric Johnston over at Cantor Fitzgerald pointed out to us earlier in the hour was that lower bond yields for big tech stocks that have so much cash isn't great because when rates were high, you were kind of accounting for that cash in the valuation. So who benefits as rates go down? Because you're not seeing it in the Russell. Where does it go?
Cui bono, Nadia, cui bono.
I think if the market moves beyond this uncertainty around government policy, it could be a huge benefit for the housing market, which we know has been somewhat paralyzed by the higher mortgage rates that we have seen. We know that Treasury Secretary has been, managing the long end of the curve and seeing that we want to see long end rates come down, and that could translate. We know that the 10 years mortgage rates is more correlated with the 10 years, so if we can see that come down, that could be a positive for the housing market. But I think we have to get through these tariffs concerns because the input to housing, lumber, comes from a portion of that comes from Canada.
I mean, think about all that you need to rebuild LA, right? You need construction workers. Well, we're shipping them out of the country. You need steel. 25% tariffs. You need lumber. A lot of that comes from Canada. I mean, it's going to be expensive and take a long, long time. Am I getting too off track?
No, you're
too off track.
Well, we'll see how much this is bark versus bite.
Yeah.
Absolutely. Nadia, thank you for joining us here to end the week. Crazy week. Nadia Lovell of UBS Global Wealth Management. Now, coming up, we're going to get deeper into Tesla's tumble. We're going to take a look at what's driving the biggest slide among the Magnificent Seven stocks next. This is Bloomberg.
Time now for our top calls, some of the analyst action that we're focusing on this morning, and we'll kick it off with Bath and Body Works getting upgraded to a buy at Citi. The analyst says there is strong innovation in the Bath and Body Works pipeline. Next up is Vital Farms getting raised to a buy at Stifel. The analyst says the egg producer is well positioned for growth thanks to new farm acquisitions. Also, I've noticed that their prices are now becoming in line with just like regular mean egg producer prices. Finally, Walgreens is getting a downgrade to a sell at Deutsche Bank. The firm says reports of a potential take-private deal from Sycamore Partners will be tough to complete. And then, Sonali, Tesla investors are bracing for bad news. You've been talking about it all morning long.
Yeah, this month alone, the stock has lost, as you're showing there, almost $400 billion in market cap. The dive is thanks in part to a slowing auto business and weak sales data. For more, we're joined on the future of Tesla by Bloomberg's Max Chafkin. He hosts the podcast Elon Inc. We're going to talk about the whole Elon world here for a moment, because Tesla, the slump you're seeing, on one hand, we've been making this point in the commercial break, what did investors expect to get for Tesla out of Elon Musk's relationship with the president?
Yeah, so two things going on. One is that Elon Musk has made this hard pivot away from the autos business towards what he calls full self-driving, robo-taxis. That business is very speculative, right? It's not clear when it's going to start to make money, when it's going to start to be real. They do not have a robo-taxi yet. The other thing that's going on is his political sort of antics in Washington is starting to alienate parts of Tesla's customer base. You think of a typical Tesla driver. This is like some upper middle class person who lives in the suburbs and cares about climate change, not necessarily likely to be impressed by like a, pot stirring social media troll. So I think there's some of that going on. You're seeing it more dramatically in Europe than in the US, but you are seeing it a little bit in the US too, it seems.
Yeah, he's lost, $90 billion year to date. Will Shaker in the control room looking at his wealth for us. $90 billion year to date, which still makes him an incredibly wealthy person. Does he really care that much?
But does he make some of it up on some of the other enterprises? He's getting Starlink deals with the relationship to the FAA.
So worth saying, at least I last checked, he's still up since the election. I mean, I think it's no longer this insane increase, probably between 10 and 20% or something. And as you say, he is doing well. He is still wealthy, and he does have these other venues to increase his net worth. We've seen SpaceX's valuation is actually coming up quite a bit because and now it's a private company, so the dynamics aren't exactly the same, but there's a much clearer story of how does Elon Musk profit from his proximity to Trump. With Tesla, much less clear. I do think Elon Musk cares about Tesla's valuation, both because it's just who he is. He cares about the company, but also because he is not the most liquid person in the world. This stock is still an enormous part of how he's going to be able to finance other deals. If he wants to, start a seventh company, which you never know, he could do that, or do a buyout or something. So he is going to care about this. It's just not clear, I'd say, how much.
We talk about Elon Musk as though he's been distracted just by politics, but to your point on other companies, I don't know if you saw the scoop this week that we had.
Of course I saw it. I work here.
Well, you were driving hogs. Who knows?
I know, but it had a green bee, so yes. I look, that's not going to make up for the amount that he's lost at Tesla.
But the amount of influence and power it gives
I think the
him.
power is key, and that seems to be, what he is high, at least one of the things that he's high on right now. So in terms of his actual job, his main focus right now should be cutting U.S. government spending.
Is that his main job?
I think so, yeah. Isn't it?
At the moment,
he's in Washington every single day, right? He goes to the White House every single day. He's not in Fremont. So if his main job is cutting government spending, is he really going to be successful in that endeavor when right now he's just sort of angering federal workers, which makes such a small percentage of the budget?
I mean, look, I think there are things that DOGE is doing that probably could be successful. It's just that when you're, as you say, Matt, like when you're going after the federal workforce, which is a very small part of the budget, plus, doing a lot of things where there's potential for litigation, for employees to be called back to work, for lots of ways in which this could sort of go sideways. The other thing I want to say is, as much as these companies are independent, their valuations are definitely linked. And you could, if Elon Musk, if Tesla falls dramatically, that could affect SpaceX's valuation because it also benefits from the Elon Musk aura, from the Elon Musk brand. All of these companies do, and we've seen all of their valuations go up. In the wake of the election, you could see the same trend in reverse. And I think ultimately, people talk about like what could drive Trump and Elon apart? Is Trump going to get so mad at Elon Musk? I think a more likely outcome would be Elon Musk decides that this is hurting his companies. And it hasn't yet, right? Because even with Tesla's, even with what's been going on today, the stock is still, relatively high. But it could, and you could see that lead to a political shift.
Thank you for always staying on it. A lot to watch in the Musk world. That is Max Chafkin of Bloomberg, and don't forget to catch his podcast, Elon Inc. I get frustrated here because you have Tesla as a publicly traded stock, but SpaceX and Starlink, because they're private, they're only available to only very wealthy investors.
Yeah. And it should be said, a lot of their business funded by much bigger, spending coffers in the U.S. government. Military spending is what you go after if you want to cut waste and fraud. Medicare and Medicaid spending is what you go after if you want cut waste and fraud. I stop Max in the hallway and talk to him about this.
There's a lot to talk about.
Every time I see him.
Anyways, yeah.
Last April, this is your wheelhouse, right? A city customer expected a $280 credit from the bank and instead got way more money than Elon Musk has, right?
$81 trillion. That is multiples more than Citi even moves in a day. We're going to talk about that next in the Wall Street Beat. This is Bloomberg. Now, Citigroup is back in the news for a massive credit error. Back in 2020, you might remember, it accidentally credited Revlon $900 million to its holders instead of $8 million, and it only got $500 million back. This time, Citigroup credited $81 trillion into a customer's account. It was supposed to be $280. This is all according to the Financial Times. It took 90 minutes to correct. No funds left the bank. We're going to discuss what's at stake with Bloomberg's chief Wall Street correspondent, Sridhar Natarajan. The problem here is being able to catch these mistakes. If I was Jane Fraser and I saw this down the road, it went through many hands, wouldn't I be saying WTF?
Look, this was bad. It wasn't Revlon bad because the client ultimately didn't get that amount over which Citi had to have a big fight. And in the end, ultimately, I do believe Citi got most of that money, if not all of that money back, but it was a long battle in the legal system. This one could have been quite bad, but at least it was caught. That's still not going to be any solace for regulators. And you're right. Therefore, the CEO, who's now 4 years into her tenure, 4 years into a tenure where she said solving the regulatory issues, improving risk management and data governance and data compliance is her top issue.
That's really what's at
stake.
She
will be frustrated.
Here.
Absolutely.
I mean, does this become a regulatory issue for these types of mistakes? $81 trillion on a piece of paper should be something bankers catch.
Look, let's play fantasy for a second. This client was supposed to get $280, was credited $81 trillion. However brief, not just more wealthier than Elon Musk, the 3 times the size of the US GDP. That's more than the 10 top GDPs of 10 top countries combined. So that would have been a big error. So there's no way in the world that this would have actually gone through. But that's not the issue at hand, is it? Citi has come out with a statement where they've said, this is why we've been talking about the need to automate a lot of these processes, because it was a manual error in this case. But instead of $280, what if it was, instead of $81 trillion, what it was $2.8 million, $28 million? Would that have gone through? Could have gone through, and that's the issue. That's the problem that Citi has been battling. And the FT actually cites that the report to the regulators say in the last year they've had 10 near misses of $1 billion plus payments. That's a problem, and they need to address it.
I would take that and peace out to Zug, Switzerland, like Mark Rich, so fast. Sri, thanks very much. Reminder, next week is Bloomberg Invest. We're going to be there live. More coming up. This is Bloomberg. Welcome to Open Interest. We are 30 minutes into the trading day. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today. And coming up, tech troubles. HP's outlook falls short because of tariffs and rising costs. And HP CEO joins the show in just a few moments. And speaking of rising costs, we're going to speak to Red Robin CEO GJ Hart as he pushes around with his turnaround plan for the burger chain. Plus, liquidity risks. The SEC raises concerns over Apollo and State Street's private credit ETF that was launched just this week.
All right, we're going to cover all that and more for you. Right now, I want to take a look at what's going on in markets. In terms of the broader industry level, we're seeing gains on the S&P right now, but only up to 58.71, 58.72. So a long way off from the highs that we saw just last week. We were at 61.44. The NASDAQ right now unchanged, and the 10-year yield continues to fall. Okay, it's only 2 or 3 basis points, but down now to 423.49. And Sonali, as you were pointing out, in January we're at 475.
If you were going to talk to me a week ago, many people would have said you were likelier to hit 4% than 5%. Now the people, and there are a few of them out there calling for 3.5% by the end of the year, they look like they're in the lead today.
Yeah, absolutely. And then there's some individual movers we'll talk about throughout the program. Duolingo was shocking to me, down now 20% at the open after disappointing results. But let's talk again about the broader market. Katerina Simonetti joins us, Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. Katerina, it is, I think, surprising to a lot of people that not only do we see real stock market weakness here 5-6 weeks into Trump 2.0, but actually, compared to the rest of the world, the worst start to a U.S. stock market since 1994. Is it underperformance here, overperformance there? How do you look at it?
Well, Matt, it's an absolutely fair question. We can't discount the fact that historically month of February tends to be quite volatile, and we're coming off the historically high performance over the last couple of years, especially in Max 7. And the biggest risk to this market right now, in our view, are valuations here in the U.S. and concentration in investment portfolios, not to mention the potential for inflationary concerns given the tariffs and, of course, the headlines with DOGE and policy changes, and so many of them coming in such a short time frame. So we expect a lot of volatility over the next 6 months until we get clarity on the policy, on tariffs, and quite frankly, we are not the only ones. Fed is paying very close attention as well.
Right. If you think about the end of last year, the trade was certainly around U.S. exceptionalism. And then all of a sudden, we get into 2025, and you're looking at the worst performance of the S&P 500 relative to the rest of the world, say the MSCI, since 1994. So if you're looking for places to diversify, is it internationally? Is it in bonds? What's the diversification trade, Katerina?
Well, Sonali, the biggest surprise to this market has been performance in European stocks. When you look at last 3 months, they're up 13%. And no surprise, I think that largely it is driven by potential for a peace agreement of some kind in Ukraine, potential reinvestments in Ukraine, the rising defense budgets in Europe, and also the, quite frankly, hopes that there will be reinstated natural gas supplies from Russia. All of that is very much a maybe at the moment, but there is hope that some change is about to happen there. So that may be one factor that is driving the European markets. And Europe is not the only one focus for us internationally. China, Chinese stocks, are looking very good. And this is, again, not to say that we don't see opportunities here in the U.S. There's always something in the market that is going to be bullish. And plus, we're seeing this general broadening of the market. But the leadership in the market here in the U.S. is certainly changing.
You expect the Federal Reserve to cut rates twice. Is that right, Katerina? We got, I guess, confidence-inspiring inflation numbers. The Fed cares more about the PCE than it does about CPI, and we saw the core PCE running down to 2.6% year over year. How do you sort of arrange your investment strategy around the idea of really continued lowering of Fed rates?
Well, absolutely. Fed will probably cut rates this year, at least once. We're expecting 2 rate cuts, but they're very much on hold at the moment. And, primarily this is driven by the tariff policies and this inflationary concerns that we all share. But there's also another factor here is the labor market. And if we are going to be seeing some weakening in the labor market, that might change the Fed perspective. But the reality for investors is that we are going to be in the highest interest rate environment, higher interest rate environment for longer. So this is the time, once again, to take advantage of the higher yields in fixed income, make sure that we have, well-represented, well-diversified portfolios, not just on the stock side, but also on the bond side, and also, quite frankly, rebalance the portfolios, because that is a major risk. If we look back last year, the best performing sector of S&P was not tech. It was financials, up 32% for the year. And this is that's why having all the different sectors represented in the portfolio, especially with focus being on potentially sectors that are not quite as affected by tariffs, it's going to be the key.
You think about just how much we've seen in terms of downdrafts in the S&P 500 and the NASDAQ, in the Magnificent Seven. With all of the concerns you're outlining, at what point do you recommend to buy the dip? It's clear that many dip buyers are not coming in more recently.
Well, it's important to know where our focus should be. And quality stocks have been driving this market. So when we look at individual securities versus broad market indexes, this is where we find opportunities in sectors like financials that benefit and do very well during the high interest rate environment, as well as domestic manufacturing, software, healthcare. We see sectors of the market that present very clear buying opportunities, and buying on dips and strategically positioning this high quality, well-performing stocks with positive earnings in the portfolios makes tremendous amount of sense.
Katerina, great to talk to you today. Thanks so much for joining us. Katerina Simonetti there of Morgan Stanley. I want to bring you some quick breaking news on Intel. The Columbus Dispatch says that Intel has slowed the building of its promised $30 billion semiconductor project in Central Ohio. Construction there now won't be completed until 2030, and the factory might not open until 2031, so 6 years from now. And this is the second time this year, in this short year so far, that Intel has delayed this project so important to Central Ohio.
One great fear I have of the AI boom is between these plants that are supposed to be being built across the country from Intel and others, and between the CHIPS Act, what if it doesn't all come to fruition?
Yeah.
At the end, these were jobs on the line. And if we don't get that exuberance, does AI productivity outweigh the benefits, at least when you think about societal impacts?
Yeah, I think actually David Weston for Wall Street Week has gone to Ohio. He's been to the site and noted that there are businesses opening. Home values have increased. Like, everybody has invested in this. Even Intel, I think, has already put like $4 billion into this.
Very serious on-the-ground implications.
Yeah, all right. So important note for the chip maker and for the great state of Ohio, home to national champions, the Ohio State Buckeyes. Coming up, HP getting hit by tariffs on goods from China. We'll speak with the CEO about the company's latest results next. This is Bloomberg. Getting out of high interest, look at what's making headlines around the world. Ukrainian President Volodymyr Zelenskiy will meet with President Trump in Washington this morning. The two leaders are expected to sign a minerals deal after Trump called Putin last week to discuss a peace plan. Analysts will be watching for any mention of specific U.S. security guarantees in any ultimate deal to defer further Russian aggression. And the Social Security Administration in the U.S. cutting half of its outsourced IT spending in efforts to keep its full-time staff employed. The acting SSA commissioner said the actions were in response to reductions that were mandated by Elon Musk's Department of Government Efficiency. The emphasis on cutting contractor roles underscores how the DOGE cuts could hit private sector companies that do a lot of government work. Preparations are in full swing for the Oscars, hosted by Conan O'Brien on Sunday. Among the nominees for Best Picture are Anora, The Brutalist, Conclave, A Complete Unknown, and Dune 2. The stars of those last two films are the one and only Timothée Chalamet. Stands a chance at becoming the youngest ever Best Actor winner, but to do that, he'll have to be the current youngest ever Best Actor, beat the current youngest Best Actor, Adrian Brody, who is also in The Brutalist, and that film is awesome. All right, let's get back to business here. Shares of HP are down this morning after giving a profit outlook that fell short of market expectations. The computer maker citing the impact of rising component costs and tariffs on goods from China. Joining us now is Enrique Lores, HP CEO, as well as here on the desk with me, co-host of Bloomberg Technology, Caroline Hyde. Enrique, let me first ask you about these job cuts. You're going to cut 2,000 workers, or as many as 2,000 workers, to save $300 million a year. Must be partially in response to these tariffs, right? Where are those jobs going to be lost?
Well, first of all, thank you for having me here. This is part of the restructuring program that we started with the company almost 3 years ago, and we have been very selective and very strategic of where to make these cuts. And actually, it's not only cuts, we are more doing rebalancing because at the same time, we're investing in other areas. But that's really a part of a long-term plan that we have put in place, and really we are now about to finish that at the end of the year.
But where? Where are those jobs, are American jobs going to be lost here, Enrique?
I think it's all over the company. We have been identifying areas where we needed to be more precise, and we haven't shared externally the specifics of where this will happen. But I can tell you is one of the decisions we make with more care because we know the relevance this has for our employees.
Okay, we know that you were looking at stripping out costs. When it comes to the stripping out of costs, is it, as Matt implies, in reaction to also the component costs that are going up, the China tariffs, as we've been speaking about on the earnings call, for example?
I think it's a combination of multiple factors. When we look at the short term, clearly component cost and tariffs are going to be having an increase, but also this is part of the effort to make the company more competitive in the long term and to be able to invest in the areas where we see long-term growth. We are positioning the company to lead in what we call the future of work, and this requires incremental investments in areas like AI, in areas to like customer experience, and this has been driving these savings, allow us to also invest in the areas of growth for the future.
But how quickly is the AI PC, for example, really coming on tap and driving demand? I know there's good growth, 25%, but it's from a standing start. So ultimately, when do you think the percentage of AI PCs will match what's already being shifted to the market, for example?
Our current expectation is that by the end of this year, AI PCs will represent more than 25% of all PC shipments. So it's really growing very fast. As you said, market-wise, quarter over quarter, we saw growth of 25%. So they are starting to be a relevant part of our portfolio and a relevant part of the mix. And this is because of the incremental value that they bring. When customers use that, they can experience AI at the edge, which means it is lower cost, it is cheaper, it is faster than doing it in the cloud, and it's also more secure because you can use your local data. You don't need to bring the data to the cloud, and you can manage everything locally.
So part of the reason that the Trump administration is putting on these tariffs is to bring production back to the U.S. And obviously, there's not a lot of computer final assembly in this country, or printers for that matter. Are you reacting at all to this by moving production to the U.S.?
What we have learned during the last 3 years is that we always need to be looking at different scenarios of how to evolve our supply chain. And this is what we have done in the last 2 years. moving manufacturing to the US is one of the scenarios that we are contemplating. We haven't made any decisions yet.
How expensive would that make components, though, Enrique? Are we going to see pressure on component prices and your ultimate bottom line continue if you're having to shift the manufacturer closer to the US?
I think one of the challenges of bringing manufacturing back to the US is what you just said. It's not only the assembly that we will be doing, is what will it take to bring all the different components, all the different suppliers that we have, and have them manufactured here. And this is going to be a much longer process, and it's part of the evaluation that we are doing.
Is there much incentive for you to do so other than political pressure? Are you getting enough carrot rather than just stick coming from the federal government?
I think there are different reasons to make our supply chain footprint more flexible, and this is what we have been doing over the last years. One is requirements from different governments, and different governments have put in place different requirements. Also, another incentive is logistics cost. It will be, of course, cheaper to produce products closer to where customers are, and also provides more flexibility and in terms of time for response to customer demand. So there are some benefits of building products locally, and this is one of the reasons that where we have gone from a very centralized model that we had a few years ago to a more decentralized model that we have now.
Enrique, how is the brand progressing? You know, somebody of my age knows the name Hewlett-Packard, but not the simple two-letter acronym HP. You have, obviously, a real opportunity to make a change there as the kids start using computers more for AI, or as AI starts to drive sales. So how is pushing this brand and your growth as simply HP progressing?
We think that the brand is one of the key assets that we have in the company. And during the last 24 months, we have significantly increased the investment that we do in the brand. And we, for example, have signed some global sponsorships with key sport teams to be able to really make the brand more visible. And this is, for example, why we signed an agreement with Ferrari to be the title sponsor of Ferrari last year. Additionally, to bring kids, this is one of to the brand and to the company, this is one of the areas where our gaming business is relevant. We are one of the key gaming suppliers in the world, and by having a strong presence in gaming, we can attract kids and young people to the brand.
You're talking Matt's language when you bring up Ferrari.
And video games.
And video games, for that matter. Enrique, going into the weeds here a bit on the tech side of things, you made a really interesting purchase recently of Humane. It was a much-hyped generative AI hardware and software company, ex-Apple founders. They sold to you the talent, the tech, but not actually the hardware pin. I'm interested in, you're not thinking about generative AI as a hardware piece in that respect. How does it help your business?
We think that the acquisition of Humane has been a very smart move for us. We are getting a very talented team, and we are getting key software technology that we can integrate in the rest of the portfolio. One of the key strategies of the company is really about integrating AI into all of our products so customers can experience AI at the edge. And Humane has key technologies that will allow us to accelerate that development. So it's really a big part of where we are taking the company, and we are very pleased having been able to do that.
Enrique, really appreciate the time today. Enrique Lores there is the CEO of HP. And, of course, thank you as well to Caroline Hyde of Bloomberg Tech. No, really appreciate it. Please bring us more.
When they mention Ferrari, too.
Exactly. I mean, Ferrari is really a tech company, right? And each of their suspension pieces on the new SUV are like supercomputers in themselves.
And aren't we seeing the pressure on the computer on wheels that is Tesla at the moment? And just ultimately, all of these business, whenever you go to the Mobile World Congresses of the world, the big tech conferences, they'd always basically be about autos. I'm about to go there, just a little shout out. But in general, it has been all about the autos, all about the intersection of car. And it's so interesting when you speak to Mark Gurman, just really saying the biggest loss that Apple ever made was not doing the car anymore.
An interesting story, right? CarPlay is so ubiquitous, but CarPlay is at threat in some ways.
Yes, no, that I think was the most interesting thing I learned last week of anything.
But I also loved how you tried to push him on, like, where are these job cuts happening? How are they happening? Because this is something we've got to focus on. When you got Autodesk, the software company, today also announcing 1,300 jobs going. You've got almost 2,000 coming from HP. This is a drip, drip, drip effect. We are not seeing the jobs being added that maybe we thought with technology. Data centers don't employ that many people.
And to the point that you've been making here, so many different job cuts for different reasons around the world and in the United States. Remember, Meta also announced some job cuts as well. Caroline, we have to leave it there. We thank you. You are a real hero to the whole network this week. Still ahead, Microsoft hanging on. They're hanging up on Skype after 14 years. Some are disappointed. We're going to tell you about the disconnect next. This is Bloomberg. And it's time now for social climbers. The company's making waves this morning. And first up, it's Microsoft saying that it's the end of the line for Skype, the iconic internet calling and chat service that it bought almost 14 years ago. Skype has been upstaged by smartphone communication apps and Zoom video calls. When Microsoft tried to stretch the Skype brand into the workplace, it lost out to Slack Technologies. And next up, Monster Beverage beating fourth quarter sales driven by higher prices and growing demand in the United States. One area, though, that lagged is the company's alcoholic beverage brands, which notched year-over-year declines. So Monster is one of your biggest gainers in the NASDAQ 100 today. And Duolingo shares, we're watching them cratering after the language learning company reported that fourth quarter results raised some flags for Wall Street analysts, and that includes AI-driven cost pressures and FX concerns. Now coming up, Red Robin is on the comeback trail in its competitive fast casual industry. Red Robin CEO GJ Hart joins us next. Stick with us for that conversation. This is Bloomberg. The turnaround plan at Red Robin is underway. The historic burger chain is making some big changes. GJ Hart took over in late 2022 after a years-long slump for the firm's stock, and his plan is starting to pay off. The company minted the best performance in the last 2 quarters, and the changes come at a time when a number of inflationary headwinds are challenging the food industry. Joining us now, GJ Hart himself, CEO of Red Robin Gourmet Burgers. You know, interesting time to be navigating in your industry, especially because the cost of some types of food have been leading people to change course. For example, Shake Shack has been warning that competitors may double down on beef and chicken with egg prices surging. And if people are doubling down on beef, then do beef prices get impacted? How are you reacting? Are you making any changes to your offerings given what's going on?
Well, here at Red Robin, first of all, good morning. Good to be with you. Here at Red Robin, in our turnaround and just we call it a comeback here, we've had a lot of fundamental blocking and tackling work we've had to do. And so part of that is really reinvesting into food quality, raising up to standards at Red Robin, and we've done that now. So I would tell you, we're not changing course from our overall North Star plan, as we call it. But there's no question that inflation are headwinds in our industry, and the consumer's ever more sensitive to pricing, and there's more and more value out there. So we do it around appointment dining, which is taking lower volume days of the week and promoting and having some price points. But what our strategy is with that, it gives guests the opportunity to come into Red Robin and really see what we're up to, and that there's a whole new Red Robin here, and that we're worthy of getting in their consideration set.
It's a far more labor-intensive restaurant than maybe other burger chains around the U.S. How have labor costs been, and how is it managing a labor force right now?
Yeah, so there's no question. There's pressure on labor, particularly out in some of the high minimum wage states. In our comeback strategy, it was reinvesting labor back into our business so that we could provide the appropriate hospitality and fun to our guests. And we've been doing that. And now, as we enter into the third year, or this year in 2025, we're really focused on the efficiency we can gain, because we've had to retrain and rewrite every training manual for everything that we're doing. And so now that we're through that, we can really focus on becoming much more efficient. And that is one of our priorities this year.
Do you worry about labor costs moving forward as well? With the immigration policies that are being put forward by the Trump administration, there have been a number of restaurant companies in particular that are worried about what that would mean for the cost of labor.
Yeah, well, it's yet to be seen. One of the things that we have here at Red Robin, with being a 56-year-old brand, we have a lot of long tenured team members all over this country, and so that's a good staple and steady group that we have, and we're pretty well fully staffed around the country. So we're definitely paying attention to it, but I wouldn't tell you that I'm overly worried about it at this point.
How hard is it to operate as a, fairly old brand? I mean, you're at least as old as I am, in a world when these kind of smash burger, trendy restaurants are growing so prolifically. How do you keep the brand fresh?
Yeah, well, first I would say that Red Robin has been known as the burger authority, really mixing different flavors with burgers and doing some very unique and different things like our lava queso burger or our Mad Love burger or jalapeno heat wave, things like that. And so we continue down the path of innovation and being really the leader around being the burger authority on gourmet burgers. But there's no question that some of the more fast casual concepts, they're growing fast and certainly have some intrusion and competition to us. But remember, we are a full service experience here at Red Robin and what we call casual dining. And so if you want a great experience for a night out with your family, we're the place to go. And oh, by the way, we really will give you some unique opportunities to try different products that have unique flavors. And so from that aspect, we're a little bit different than most of those other folks.
I wonder about New York City. I don't believe there's a Texas Roadhouse here, which, is your previous employer. And I know there's no Red Robin here because I was looking for one all day yesterday. So why, it's not just you, why do a lot of, nationwide restaurant brands skip New York City?
Well, I think, listen, we don't have anything in New York City. We do have plenty in New Jersey. Part of it is just in an economic model in the restaurant business, occupancy costs are a key component. And in places like Manhattan or New York City, it's super, super expensive. And there is a ton of competition. And so there's so many, and if you're a casual brand like us, there's just so much white space around the United States. We're a community brand. We want to be part of communities. And so, it's pretty tough to be part of Manhattan as a, one restaurant in a big sea of other folks. So I think that's part of it. And if you really want to put it as a showcase, things like Times Square, lots of people will do that. Certainly you can do that, but you need to be willing to understand that that's going to have cost ramifications and be pretty tough to make money.
I want to go back to something you were talking about a little earlier, where consumers really are cost conscious, and in your industry in particular, there have been a lot of value offers out there, $5 value offers in particular. That seems to be a golden number. I know you offer that $10 cheeseburger Tuesday, for example. Do you think that you need to go lower in price point because of what you're seeing from fast casual?
Well, we have a very varied menu. So we have a lot of value on our menu with our tavern lineup of burgers. And again, we're a full service experience. So when you combine that fact, we think we are very, very value oriented from that aspect. In fact, all of our consumer sentiment and our scores from guest satisfaction show us that our value continues to improve. That said, when you start to have price points, particularly in the fast food or fast casual folks that are that cheap, certainly people wonder. But at the end of the day, we think we're hitting the right mark. So we have our Monster Mondays, which is essentially where you can get $1 or $2 off on items, and you can really get a lot of value there. As you mentioned, Cheeseburger Tuesdays, we're getting double-digit growth there. So certainly those are lower volume days of the week, and we think that helps us get people, and we're seeing it, their frequency on the weekends is higher now as a result of that. And our guest satisfaction scores, again, reflect that. We've hit all-time highs in guest satisfaction scores since we've been tracking with Technomic and with SMG, our current partner. So it's telling us that I think we're doing all the right things. But clearly, this value message hopefully will start to dissipate for the industry as we go through 2025, because it's a tough one.
All right, GJ, thanks very much for joining us. Look forward to attempting to get one of your burgers sometime soon. GJ Hart there of Red Robin Gourmet Burgers. I want to take a look now at another iconic American company, Harley Davidson. I spent a few days in Austin, Texas this week checking out the new 2025 lineup. But before we talk about the bikes, I want to take a step back in time to get the original story behind the iconic nickname Hog. Ever wonder why Harley Davidson motorcycles are called hogs? Legend has it the moniker originates over 100 years ago when a Harley Davidson racer named Ray Vishar took a 6-week-old piglet called Johnny under his arm. In 1920, Ray bought the runt from a local farm to serve as his personal mascot in the days leading up to Indiana's Cornfield Classic. When Ray takes his victory lap, he does so with Johnny in tow. So you could say Johnny was the original hog. All right, could also be, Harley Owner Group, or it's Hog on the terminal. But the interesting thing that I learned this week is that Harley Davidson has done so well in racing, which started out as a fluke about 5 years ago. These giant baggers, not these kind of little cruisers that I was riding, but the huge road glide and street glide baggers are racing, and it's caught on so much with Americans that they're really pushing the brand towards sports bikes. So the Lowrider S and the Lowrider ST have a high output 117 cubic inch motor that just moves, and it's so much fun.
First of all, I love that package. That pig was very cute.
Johnny.
And on the racing here, which scares me, but frankly, is there kind of sports franchise being built around it yet?
Yeah, absolutely. So it started out as, I think, kind of a fluke. Harley versus Indian in 2020, but those brands have both put so much into it, and it's become so popular, not only here in the U.S., but also in Asia, that they're teaming up with MotoGP, they're at the Moto America races, and it's becoming something that a lot more people are tuning in to watch, and the racers are becoming household names.
Feels like it needs a Netflix show.
Yeah, no, it would be an awesome. I spent some time with some of the riders, James Rispoli and Kyle Wyman and his brothers, and these guys are fantastic young athletes, so it definitely would make a great series.
The next big show for Matt Miller.
The next big thing.
The next big thing. Let's look at the next big thing in the markets as well, because we are seeing a turnaround story. It has been days like this in the market. Wait, isn't the next big thing your thing? The next big risk.
The next big risk.
Right.
Okay, that's one of your things, but the other big thing that you do is
next week.
Bloomberg Invest.
Yeah, and it is an interesting market to invest in. We are turning around today. Things have been very volatile. I know, we started lower, bad moods, but it's interesting to me because it's still a bad week. The S&P 500 is not going to erase any of that, but the NASDAQ 100 started with some really sour moods. The 10-year now back to 425, so it's been fluctuating a couple basis points all day. And to your point, ending on this kind of a note does bring us to all that excitement around Bloomberg Invest next week. It's a huge conference, Matt. You have the CEOs of Carlyle and Bridgewater, the president of Apollo, John Gray over at Blackstone. They will
Tom Wagner, Gary Cohn.
You can talk to Tom about hogs. I'm sure he'll entertain you. We're going to be broadcasting live on set from there, all three of us. But stick with us, because up next we are going to bring you more on what's happening under these volatile markets. Stick with us. This is Bloomberg.
Time now for our Wall Street Week conversation. The Consumer Financial Protection Bureau is moving to drop a suit against Capital One that it brought during the Biden administration. That suit accused the bank of cheating customers out of $2 billion. The Bureau is at the center of the Trump administration's effort to slash federal spending. So where does that leave the future of bank regulation? David Weston put that question to Columbia Law School professor Catherine Judge.
Catherine Judge specializes in regulatory architecture and banking at Columbia Law School.
The regulatory structure when it comes to financial regulation is an absolute mess. I don't think anybody would disagree with that. We have the CFTC and the SEC as two different market regulators. We have 3 different banking regulators overseeing banks. So I think there's a lot to be said for saying, let's look at the overall regulatory regime and let's come up with a blueprint that significantly simplifies that regime. We've had a bunch of executive reports, the Volcker report that really tried to say, here's how we can have a more rational and more systematic regulatory regime. That's not what we're seeing right now, but there's a lot to be said for moving in that direction.
We have a new Trump administration, and it is dedicated, among other things, to deregulation. One of the first places it's focused is the CFPB. Tell us about whether they have a point that maybe the government went too far in regulating the banks in the CFPB.
I mean, there's some really interesting questions there. So one of the key things to note about the CFPB is that a lot of what it was trying to do was just level the playing field between banks and non-banks. So banks long had obligations to engage in fair lending and to provide truth in connection with their lending activities. And a lot of what the CFPB did said, we have this really robust system of oversight and enforcement for banks, but we have all these non-banks. Let's make sure we have a more even playing field, and then let's create a separate regulator. So that way they have to kind of all do these things together. But one of the important things to note is it didn't create new law. What it really did was just change the supervisory mechanism and the enforcement mechanism around existing laws. And so there's a lot to be said for questioning kind of what is the optimal level of regulation, what is the optimal level of enforcement, but then you actually have to get the substantive law rather than this kind of structure through which it's actually enforced.
There have been consumer protection laws in the states for many, many years. If the CFPB were to go away, could the states step in a federal system and do some of what we need the CFPB to do?
So the states are certainly going to step in. They can play a very important role in this domain. They're not a perfect substitute, and actually it makes it very difficult for regulated entities because suddenly you're having to look at a lot of different states. So one of the things that's really important to note if you're a regulated entity is right now you might be really frustrated with the underlying rules, and you might look at the CFPB as a face of the body that's implementing those rules. But you're not going to get out of any of those rules or legal obligations. You're not going to be able to avoid the possibility of enforcement. It's just going to come from a different source.
Talking about regulating the banks, and the non-banks for that matter, right now, beyond the CFPB, you are an expert in this area. Are there places that we could make sensible reforms? You said the system overall is a mess.
There's a lot of ways we could make very, very sensible reforms. And I think we could make sensible reforms in terms of structure. There's also a lot of sensible reforms that we could make in terms of the nature of the actual regulatory burdens. We have a tendency with both structures and burdens to be additive, just layer a bunch of things on top of each other and not think holistically about how they all fit together.
And that was David Weston speaking with Katherine Judge. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
I think ETFs in equities make a tremendous amount of sense. In credit, by contrast, I don't think it's an interesting product broadly. There's not liquidity in necessarily the underlying names, particularly as you get more private. But to me, the bigger concern is the broad market is not attractive.
That is Robin Dumar from Park Square Capital discussing the highly anticipated State Street and Apollo private credit ETF. Now, Bloomberg is reporting that the SEC is also expressing their concerns and asked the firms for more information, according to a letter that was filed yesterday. Joining us now, Bloomberg's Emily Graffeo to talk about the letter, talk about the remaining concerns. Presumably, the SEC did let this launch. And it's interesting from the sake of Apollo, because Apollo has a lot of insight into the way the SEC works. For a long time, they had Jay Clayton, the former SEC chair, now onto a different role in the Trump administration as a key director of the firm. So what are the remaining concerns from the SEC?
So the SEC is concerned about the fund's liquidity, which is something that there were a lot of questions about before the fund actually launched. We know that you can only have 15% illiquid in a fund. We know that when the fund launched, they said that they're going to figure out a way to have up to 35% or even more of private credit in the fund, which is traditionally considered not as liquid. But they said that because Apollo has this trading desk, Apollo's providing the liquidity, everything's going to work. The fund launched. Now the SEC is coming back and saying, well, wait a second, That's a concern. They're also concerned about the fund name, which isn't completely unprecedented, but I guess they don't like that it says State Street and Apollo in the name. So, and then they also said that its ability to comply with valuation rules was a concern. It was a pretty long letter.
So basically, Apollo had to commit to buying and selling being the sort of the primary dealer, right, for this ETF.
Liquidity backstop.
Yeah, but it was an undefined amount of buying and selling that they committed to doing, which I don't understand. Like, shouldn't you have to define that sort of thing? That's one of the most important aspects of this entire ETF. So the concern is if they reach that undefined ceiling, which I guess only Apollo and State Street know about, top secret, super opaque, then they're going to have to start selling off their publicly traded assets and drive down the price of this ETF. It seems like a disaster waiting to happen. When you see undefined in a filing, shouldn't the SEC find out what that limit is?
Yeah, typically before a fund actually goes effective, before the issuer launches it, they're having a back and forth. We don't know about it. The public doesn't know about it, but they're having a back and forth with the SEC and addressing these concerns. And so the ETF industry, when we saw that this fund did launch and it did go effective, we had all assumed that all of those concerns had been addressed. Now, I will say the ETF is still trading right now. The SEC could issue a stop order, but that's pretty rare. We haven't exactly seen that. So far, what we know is that it's still trading. It's out on the market.
Right. It's kind of amazing. If you look at the letter, there are points of this letter, including your point that you're making about the liquidity backstop. We're available to discuss this further, they say. So it's like getting a really scary email from your boss, really.
Or from Elon Musk.
Or from Elon Musk. Emily, how were the flows to this? Because clearly there's a lot of questions in the market about how this would work. And when it comes to private credit, actually, a lot of people are wondering, since it's not only private credit, since it's liquid investments as well, is there a return drag that would be experienced? It's not like you're getting pure private credit returns in this type of a vehicle.
Well, we only had one day of trading. So we did get a pretty small inflow of about $1 million. A lot of times with these other ETF launches, like the Bitcoin ETF launches the first day, we had massive amounts of flows and liquidity. The fund size right now is 51 million, but 50 million of that was a seed. So we still don't we don't have a lot of data in terms of like how this is actually trading and whether market makers in the industry are getting the liquidity that they need. We haven't obviously seen a redemption yet. That's where the issue of the liquidity and valuation would really come into play.
Certainly something people are watching very closely. We thank you for watching it closely. Emily Greifeld of Bloomberg News. And for more, you can tune in to ETF IQ every Monday at 12 p.m. Eastern. And also coming up next week, we're live from Bloomberg Invest March 4th and 5th. We're going to be speaking with a host of guests, including Diameter CEO John Lewinson, Carlyle CEO Harvey Schwartz, Soros CEO Don Fitzpatrick, and Bridgewater CEO Nir Bardea. For more information, BloombergLive.com/invest. We're going to be talking more about liquidity in these private markets with some of those guests. But today, there's another huge interview over at Bloomberg as well.
Yeah, David Weston at 3 o'clock p.m. is going to sit down with Scott Bessent, the Secretary of the Treasury, for an in-depth interview. It'll be the only media Bessent does today, and the last time we had him on, it was pretty good. So I'm really looking forward to this.
Beyond that, the timing is impeccable because of the meeting you have with Zelenskiy in the White House. This is going to be a critical interview to keep an eye on.
And I'll be anchoring the close, so I'll be there as well. Don't miss that interview again with Treasury Secretary Scott Bessent and David Weston at 3 o'clock on Bloomberg TV and radio. This is Bloomberg.